Look, I'm going to be brutally honest with you right now. Gold and silver just went absolutely parabolic. Everyone's celebrating, social media is flooded with "I told you so" posts, and that's exactly when I need you to pump the brakes. Because while the long-term case for precious metals is still rock solid, the short-term price action has become dangerously overheated. And if you're buying right now because you're excited, you might be setting yourself up for pain. Here's what nobody wants to hear. Markets don't reward excitement. They don't reward conviction. They reward discipline, timing, and risk management. And right now, the enthusiasm around gold and especially silver looks like late cycle behavior, where rational investors start sounding like gamblers and gamblers start feeling like geniuses. And that combination, my friends, almost always precedes sharp reversals that leave people wondering what just happened. Silver in particular has been absolutely wild. I mean, we saw this near vertical rise into late January. Everyone was screaming about $100 silver, $50 premiums, the end of the paper market, and then, boom, a sudden violent pullback that vaporized gains in hours, not days. And this wasn't because the fundamentals changed overnight. This was speculative excess dominating price action, pure and simple. And gold did something similar, though less extreme. These sharp swings are reminders that precious metals are not savings accounts. They're volatile assets, and dramatic moves happen when markets are stretched, not when fundamentals suddenly shift. Now, let me be clear about something important. There's a massive difference between secular trends and tactical setups. The secular case for gold and silver, the big picture story about currency debasement, geopolitical chaos, distrust in the system, central banks buying like crazy, all of that remains completely intact. I'm not bearish on the long-term thesis at all, but the tactical setup, the timing of when you actually enter, that determines whether you make money or lose money. And right now, tactical signals are flashing warning signs all over the place, because when you see parabolic moves followed by panic sell-offs, that's not strength, that's instability, that's leverage unwinding, that's forced liquidation. And the problem is, most people don't understand the difference between futures markets and physical markets. Futures prices can move violently because of leverage and speculation. 100 contracts can change hands in seconds. But physical supply chains adjust slowly. Refiners don't magically produce more bars overnight. And when futures get overcrowded with leveraged positions, even small triggers cause massive forced selling. Corrections in these environments are never gentle. They're sudden, they're violent, and they hurt. And honestly, that's what we just witnessed, a textbook example of what happens when too many people are on the same side of a trade with too much borrowed money. Let's talk about central bank buying for a second, because everyone loves to cite this as the ultimate proof that gold's going to the moon. And look, central banks are absolutely buying. That's real, that's structural demand. But here's what people misunderstand. Central banks are not momentum traders. They're not chasing prices. When gold spikes violently, they often slow down purchases because they don't want to appear reactive or desperate. They prefer buying on pullbacks. So while their behavior supports the long-term thesis, it absolutely does not justify chasing parabolic spikes. And the same logic applies to investment demand. We've seen record inflows into physically backed gold funds, institutions and retail piling in. But when everyone crowds into the same trade, exits become congested. And that's exactly why we saw those sudden liquidation events recently. It wasn't because people stopped believing in gold, it was because they got forced to sell. Margin calls hit, liquidity dried up, and boom, the elevator goes down way faster than it went up. Here's a concept most people ignore. Forced behavior matters more than belief. You don't need investors to abandon the gold thesis for prices to fall. You just need them to be forced to sell. And that's why emotionally charged markets are so dangerous, because leverage and crowding amplify every move, both up and down, way beyond what fundamentals would justify. Now, silver, oh man, silver is its own beast entirely. It's part monetary metal, part industrial commodity, and that dual nature makes it incredibly volatile. The long-term industrial demand story is real. Solar panels, electronics, medical applications, all of that supports higher prices over time. But that demand grows gradually. It doesn't explode overnight. So when you see silver ripping 20% in 2 weeks, that's not industrial buyers suddenly needing more metal. That's speculation, pure speculation. And the real bullish case for silver isn't these parabolic rallies, it's slow supply tightening, limited mine flexibility, and structural deficits that build over years, not days. But nobody wants to hear that because it's boring. Everyone wants the lottery ticket, the moonshot. And that emotional thinking is exactly what creates these boom-bust cycles that wipe out impatient investors. Given how overheated spot prices got, I'm actually looking at relative value opportunities now, particularly in mining equities. Because here's the thing, when spot prices spike, mining stocks often lag because they're pricing in costs, hedging, political risk, operational challenges, all the real-world stuff that affects profitability. So miners can look undervalued when spot is going parabolic. But, and this is crucial, miners are still equities. They're subject to broader market risks. So if the stock market tanks, mining gold stocks can fall even if gold holds up. They're not a perfect substitute for physical metal. They're a different animal entirely, with different risks. Professionals think in spreads and expectations, not absolutes. When spot prices are emotionally priced and equities are conservatively priced, the opportunity is in relative positioning. You reduce exposure to overheated stuff and favor assets with built-in cushions. This isn't about shorting markets or being a perma-bear. It's about managing risk and preparing for mean reversion. Because mean reversion always happens. Always. It's just a question of when and how violently. Now, let's zoom out for a second because metals don't exist in a vacuum. U.S. equities are stretched. Cyclically adjusted earnings multiples are near historic extremes. The equity risk premium has basically disappeared, meaning the market is pricing stocks as if they're unusually safe, which is frankly insane. And when equities wobble, metals can behave in different ways depending on what's causing the wobble. In liquidity-driven sell-offs where everyone needs cash, metals often fall alongside stocks. In fear-driven crises where people want protection, metals can rally. And recent volatility suggests a lot of metal exposure is still held as a trade, not insurance, which means if stocks crack, we could see correlated selling, at least initially. Bonds are boring, everyone hates them, but they're valuable stabilizers, especially when equities are offering thin real yields compared to government debt. When investors start treating stocks as risk-free, that's when complacency is highest and vulnerability increases. And I know the dollar's been weak, which is a tailwind for commodities, but don't fall into simplistic thinking here. A weaker dollar doesn't automatically guarantee rising metal prices. Confidence matters, real yields matter, policy credibility matters. Gold ultimately responds to arithmetic, get growing faster than productive capacity, not to apocalyptic scenarios or Twitter hysteria. Here's something people forget. Bull markets are volatile. Corrections of 20% or more can happen without invalidating the long-term trend. Successful investors trim oversized positions when things get frothy, they rebuild cash, they prepare for re-entry. They don't chase spikes and they don't panic during pullbacks. They follow a plan. And honestly, that's the difference between people who make money over decades versus people who get shaken out every cycle. And I'm seeing way too many people right now who have no plan. They're just riding the emotional wave, and that never ends well. Let me throw another curveball at you. Broader commodities, not just metals. We're seeing inflation pressures building beneath the surface across energy, industrial metals, agriculture, and a diversified commodity exposure can provide smoother protection than concentrated bets on the most emotional assets. Because when everyone's piled into silver and gold, other commodities can offer better risk-reward. It's about thinking like a portfolio manager, not a gambler. And speaking of competing assets, real estate, another store of value that competes for capital. In overheated markets with stretched affordability, price corrections of 10 to 20% aren't just possible, they're healthy. Housing, stocks, and metals are constantly competing for the same investment dollars, so you need to think comparatively, not just obsess over one asset class. Here's the kicker that nobody wants to accept. Confidence often coincides with peak risk. When everyone feels smart, when the gains feel easy, when your neighbors are asking how to buy silver, that's usually not the beginning. It's closer to the end, at least of that particular move. And fear, real gut-wrenching fear, that's often when the best opportunities appear. But you can't recognize those opportunities if you're fully invested at the top with no cash and no plan. So what's my take on all this? I still believe in the long-term precious metals thesis. I think we're in a structural bull market driven by factors that aren't going away anytime soon.
But I also think the short term got way ahead of itself, and pullbacks of 20 to 30% wouldn't surprise me at all. They'd actually be healthy. They'd shake out the weak hands, reset sentiment, and create better entry points for patient capital. And that's how I'm approaching this. I'm not chasing, I'm waiting, I'm watching, I'm keeping powder dry. Because the market's greatest trick is convincing you that the current price is the new normal right before it proves you wrong. And I've seen this movie too many times to fall for it again. So my advice, and this is just educational, not personalized financial guidance, think critically about risk, respect cycles, avoid emotional decisions, and remember that making money in markets is about being disciplined when everyone else is being reckless. It's about selling when others are buying and buying when others are selling. It's contrarian, it's uncomfortable, but it works. And if you can master that mindset, you'll do just fine regardless of what gold and silver do next week or next month, because you'll be playing the long game while everyone else is playing slots.